Look, I need to be straight with you about something that's happening right now in the gold market. Something that most people aren't paying attention to, but should be. Because when this thing breaks, and it's going to break soon, there's going to be a very clear line between the people who positioned themselves correctly and those who didn't. Let me start with what happened last Tuesday. The COMEX reported something unusual. Their registered gold inventory, the stuff that's actually available for delivery, dropped by 47,000 ounces in a single day. Now, you might think that's just normal market activity. But here's what makes it interesting. That same day, we saw delivery notices spike to levels we haven't seen since the March 2020 panic. People aren't just buying gold contracts anymore. They're standing for delivery. They want the physical metal. And this is where the story gets really interesting, because it connects to something much bigger that's been building for months. You remember when Nixon closed the gold window in 1971? That was supposed to be temporary. Temporary turned into 54 years. But something's shifting now. The system that replaced gold, the petrodollar system, it's showing cracks. Real cracks. Not the kind that conspiracy theorists talk about in forums, the kind that central banks are responding to with actual policy changes. The Saudi Arabia situation is the perfect example. For 50 years, they've priced oil exclusively in dollars. That was the deal. We protect them, they price in our currency, and that creates automatic demand for dollars worldwide. But in June of last year, they let that agreement expire. Didn't renew it. And now? They're accepting yuan for oil sales to China. They're talking about accepting rupees from India. The exclusive dollar pricing is over. Now you might think, okay, that's interesting geopolitically, but what does it have to do with gold? Everything. Because when the automatic demand for dollars decreases, countries need somewhere else to park their reserves. And they're choosing gold. Not because they love gold, because it's the only asset that isn't someone else's liability. The Chinese central bank has been buying gold for 18 consecutive months. Every single month. They're not hiding it anymore, they're reporting it. 225 tons in the last year alone, and that's just what they're admitting to. The People's Bank of China has a history of underreporting their gold purchases and then revealing the real numbers years later. In 2015, they suddenly announced they had 600 tons more than anyone knew about. Just casually mentioned it. But it's not just China. Poland bought 130 tons last year. Poland. A country that had barely touched gold for decades suddenly decides they need to increase their reserves by 50%. Singapore's doing the same thing. India's doing it. Even Uzbekistan is stacking gold like there's no tomorrow. And here's what nobody's talking about. These aren't just purchases, these are repatriations. Germany spent years quietly moving their gold back from New York and Paris. The Netherlands did the same thing. Austria, Belgium, they're all bringing their gold home. Why? Why go through the expense and logistics of moving hundreds of tons of gold across the ocean if you're confident in the current system? I'll tell you why. Because when you hold gold in New York, it's technically yours, but it's in someone else's vault. And in a crisis, possession matters. Physical possession. The Dutch central bank actually said this out loud. They said they wanted their gold back home to increase public confidence in the stability of the financial system. Read between those lines. Now, let's talk about what's happening in the physical market right now, because this is where it gets really interesting. The premium on physical gold over the paper price has been widening. In India, you're paying $30 to $40 over spot just to get your hands on actual gold. In China, the premium hit $50 at one point last month. That's not normal. That's a sign that the paper price and the physical reality are diverging. And the U.S. Mint? They can't keep up with demand for American gold eagles. They've had to ration sales to their authorized dealers multiple times this year. The Royal Canadian Mint is in the same boat. These are major sovereign mints, and they're struggling to meet demand. Meanwhile, the paper price of gold is being painted down during low-volume trading sessions. You see these sudden drops at 2 a.m. New York time, when nobody's actually trading, and the price falls $30 in minutes. That's not organic selling, that's algorithmic suppression. But here's the thing about suppression. It only works until it doesn't. And we're getting close to that point. Let me tell you about what happened in 1980, because there are some eerie parallels. Gold had been climbing throughout the 1970s as inflation raged. The Hunt brothers were trying to corner the silver market. There was this sense that precious metals were the only real money left. Then Paul Volcker came in, jacked interest rates up to 20%, and crushed the metals. Gold dropped from $850 to $300 over the next few years. Everyone said the gold bull market was over. But here's what's different now. In 1980, the US was still a creditor nation. We had manufacturing. We had a trade surplus. Our debt to GDP was under 40%. Now, we're at 123% debt to GDP. We're running trillion-dollar deficits in a supposedly good economy. We can't raise rates to 20% even if we wanted to, because the interest on our debt would consume the entire federal budget. And that's the trap. The Fed is stuck. They can't fight inflation the way Volcker did without bankrupting the government. So what do? They try to manage it. They try to engineer a soft landing. They try to convince everyone that 2% inflation is normal and healthy, even though it cuts your purchasing power in half every 35 years. But the market's starting to figure this out. You can see it in the gold price action. Every time the Fed hints at rate cuts, gold rallies. Every time inflation data comes in hot, gold rallies. It's not behaving like a traditional commodity anymore. It's behaving like a monetary asset, like what it actually is. Now, I want to take a quick detour here because if you're sitting on $100,000 or more in retirement accounts, this next part is relevant. A lot of people don't realize you can actually hold physical gold in an IRA. Not a gold ETF, not a gold mining stock, actual physical gold that's stored in your name. I put together a free guide on how this works, how to do it without triggering taxes or penalties, what the rules are. It's in the description below. Worth checking out if you're thinking about protecting some of your retirement savings with physical metal. Anyway, back to where this is all heading because the timeline is compressing. The BRICS nations just announced they're working on a new settlement currency for trade between member nations. Now, they've been talking about this for years, so you might be tempted to dismiss it. But this time they've got actual details. They're talking about a currency backed by a basket of commodities, with gold as the anchor. They're building the infrastructure, the payment rails, the clearing systems. This isn't theoretical anymore. And here's why that matters. The BRICS nations represent 45% of the world's population. They control a huge chunk of global commodity production. If they create a viable alternative to the dollar for international trade, even if it's just for commodities at first, that's a massive shift. That's a reduction in dollar demand. And that's bullish for gold, because gold becomes the neutral reserve asset that everyone can agree on. You're already seeing this play out in smaller ways. Russia and India are settling oil trades in rupees. China and Brazil are trading in yuan and reals. These are bilateral agreements, but they're adding up. Each one is a small crack in the dollar's monopoly. And the US response? We're weaponizing the dollar even more. Sanctions on Russia, sanctions on Iran, freezing Afghanistan's reserves. Every time we do this, we give other countries a reason to diversify away from dollars. Because if we can freeze Russia's $300 billion in reserves with the stroke of a pen, what's to stop us from doing it to someone else? This is why central banks are buying gold. It's not because they think gold is going to $10,000 next week. It's because gold is the only reserve asset that can't be frozen, can't be sanctioned, can't be printed. It's financial insurance. And they're buying that insurance at an accelerating rate. Now let's talk about the supply side, because this is where things get really tight. Global gold mine production peaked in 2018. We're producing less gold now than we were 5 years ago, even though the price is higher. Why? Because the easy gold is gone. The ore grades are declining. It takes longer to permit and build new mines. The average gold mine takes 10 to 15 years from discovery to production. You can't just turn on a switch and make more gold. Meanwhile, demand is surging. Central bank buying is at a 50-year high. Retail demand in Asia is breaking records. Industrial demand for gold in electronics and technology keeps growing. And now you've got the gold ETFs starting to see inflows again after 2 years of outflows. All of this is happening while production is flat to declining. This is basic supply and demand. When demand exceeds supply, price has to rise to clear the market. But in gold, there's a twist. Because most of the gold ever mined still exists. It's in jewelry, in bars, in vaults. It's above ground. So the question becomes, at what price do the holders of that above-ground gold decide to sell? And here's what the data shows. They're not selling. The Swiss refineries, which process most of the gold that flows from west to east, they're reporting that scrap supply is way down. People aren't selling their jewelry. They're not selling their coins. Even at $2,600 an ounce, they're holding. because they sense what's coming. I want to tell you about a conversation I had with a coin dealer in Texas last month. He's been in the business for 30 years. He told me something that stuck with me. He said, in 2008, people were selling gold to raise cash. In 2020, people were selling gold to raise cash. But now? Now they're buying gold with their cash. That's a different psychology. And he's right. The psychology has shifted. People aren't viewing gold as something you sell when you need money. They're viewing it as something you buy when you don't trust what's happening with money itself. Look at what happened in Turkey. Inflation hit 85% last year. The lira collapsed. And what did Turkish citizens do? They bought gold. So much gold that Turkey became one of the top gold importing countries in the world. Not because they're rich, because their currency was dying, and gold was the lifeboat. Or look at Lebanon. When their banking system collapsed and people couldn't access their deposits, the only people who were okay were the ones who had gold. Physical gold. Not gold certificates, not gold accounts. Physical metal they could hold and trade. These aren't theoretical scenarios. This is happening right now in real countries to real people. And the lesson is always the same. When the system breaks, physical gold works. Paper promises don't. Now, I know what some of you are thinking. But gold doesn't pay interest. It doesn't generate cash flow. It just sits there. And you're right. Gold doesn't do anything. That's the point. It doesn't do anything because it doesn't need to do anything. It's not a business that can fail. It's not a bond that can default. It's not a currency that can be printed. It just is. And in a world where everything else is leveraged, where everything else has counterparty risk, where everything else depends on someone else keeping their promise, that quality of just being is incredibly valuable. Think about what happened with Silicon Valley Bank. One day it's fine. The next day there's a run and it's gone. $16 billion in deposits vanished in a matter of hours. The FDIC stepped in, made everyone whole, but that was a choice, a policy decision. What if they hadn't? What if the next bank that fails is bigger? What if there are multiple banks at once? Gold doesn't have that risk. There's no bank run on gold. There's no FDIC insurance needed for gold. It's just there. Solid. Permanent. Boring. And boring is looking pretty good right now. Let me show you something else that's happening. The gold to silver ratio. Right now it's sitting around 85 to 1. That means it takes 85 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 60 to 1. When it gets up to 80 or 90, it usually means silver is undervalued relative to gold, or gold is about to make a big move, or both. In 2020, the ratio hit 120 to 1 during the COVID panic. Then silver exploded from $12 to $30 in a matter of months as the ratio corrected. We might be setting up for something similar. Because if gold is going higher, silver tends to go higher faster. It's more volatile, more industrial, more speculative. But it follows gold. And the silver market has its own supply issues. We're running a structural deficit in silver. We're using more than we're mining, and we're drawing down above-ground inventories to make up the difference. At some point, those inventories run out. And then what? But let's get back to gold, because that's where the real story is. The real story is that we're watching a monetary system change in real time. The dollar-based system that's been in place since 1944, that's been the sole reserve currency since 1971, it's not ending tomorrow. But it's evolving. It's becoming multipolar. And in a multipolar monetary system, gold is the common denominator. You can already see this in how central banks are positioning. They're not dumping dollars entirely. They're diversifying. They're reducing their dollar exposure from 70% of reserves to 60%, to 55%. And that money is going into gold, into euros, into yuan, into a basket of alternatives. It's a slow shift, but it's happening. And here's the thing about slow shifts. They're slow until they're not. There's a tipping point where the momentum becomes self-reinforcing, where everyone's trying to diversify at the same time, and that creates a rush for the exits. We saw this with the British pound in the 1960s. We saw it with the gold standard in the 1930s. These transitions can be orderly, or they can be chaotic, but they happen. The question is, where do you want to be when it happens? Do you want to be the person who diversified early, who has physical gold tucked away, who's protected? Or do you want to be the person who's scrambling to buy gold at $4,000 an ounce because everyone else finally figured it out. Because that's what happens. Gold doesn't move in a straight line. It sits there, it consolidates, it frustrates everyone who bought it. And then it explodes. In 2019, gold was $1,400. By August 2020, it was $2,070. That's a 48% move in 18 months. And it happened because the Fed printed $4 trillion, and everyone suddenly remembered that gold is the anti-dollar. We're in a similar setup now. The Fed's balance sheet is still massive. The government is still running huge deficits. The debt is still growing exponentially. And gold is consolidating around $2,600, building energy for the next leg up. The smart money knows this. That's why they're accumulating. Ray Dalio has been talking about gold for years. Paul Tudor Jones owns gold. Stanley Druckenmiller owns gold. These aren't gold bugs. These are some of the most successful investors in history. And they're allocating to gold because they understand the macro picture. And the macro picture is this. We have too much debt, too much money printing, too much geopolitical instability, and too few good alternatives. Gold is the alternative. It's been the alternative for 5,000 years, and it's going to be the alternative for the next 5,000 years. Now, I'm not saying you should put everything into gold. That would be crazy. But having some gold, having physical gold that you own outright, that's not crazy. That's prudent. That's what people did for most of human history, and they did it for good reasons. The window for getting positioned is still open. You can still buy gold at reasonable premiums. You can still get delivery in a reasonable time frame. But that window is closing. As more people wake up to what's happening, as the physical shortage becomes more obvious, as the premiums widen further, it's going to get harder and more expensive. And here's the thing that keeps me up at night. What if I'm wrong? What if the dollar stays strong, inflation comes down, everything goes back to normal? Well, then you own some gold. It didn't go to zero. It's still worth something. You didn't lose everything. You just have an insurance policy you didn't need to use. But what if I'm right? What if the dollar loses its reserve status? What if inflation comes roaring back? What if there's a banking crisis, a debt crisis, a currency crisis? Then that gold you bought at $2,600 is going to look like the smartest decision you ever made. That's the asymmetry. The downside is limited, the upside is enormous, and the probability of the upside scenario is increasing every day. So here's what I want you to do. Look at your portfolio. Look at your assets. Ask yourself honestly, how much of this is dependent on the current system continuing to function exactly as it has? How much of this is at risk if something breaks? And then ask yourself, do I have enough gold? Not gold stocks, not gold ETFs, physical gold, the kind you can hold, the kind that's yours, with no counterparty risk, no middleman, no promises. Because when everything changes, and it's going to change, that physical gold is going to be the difference between being protected and being exposed, between being prepared and being caught off guard. The gold stackers who are positioning now, they're not going to have limited time much longer. They're going to have something much more valuable. They're going to have peace of mind. And in the world we're heading into, that's going to be worth more than most people realize.